that with the usual disclaimers about education and all that kind of stuff. I know it's been a while for Kim, so she's probably forgot all in about that nonsense. But anyway, it's absolutely true. Trading at the moment is incredibly volatile, and if you risk too much, you are bound to end up on the wrong side of a doing. So make sure you trade with what you can afford to chuck down the toilet. And when we're looking at the markets, of course, fair value is an incredibly important subject. Unfortunately, it's also one of these subjects that is not very well understood. As I mentioned, Reeve posted a YouTube video from a quant. And this is the approach, of course, that I've been involved in for 40-something years now, 40-something years. It's over 40 years now, so we've been, involved in many of the biggest banks in Europe over the period, and building quant models from the inception of quant trading all the way through to the present moment, where it's obviously way past where it was before. The earliest quant models were all about execution, and were all about finding the best possible price, the best possible levels. We'll certainly touch on those in this conversation this afternoon as well. In pursuit of fair value, and fair value is one of those subjects that a lot of people hear a lot about this concept called fair value because they've been involved with, for example, a profile, and they understand fair value to be a POC, for example, or they understand fair value when they hear these weird phrases like fair value gaps, whatever that is. So we can understand that these concepts of fair value are flying around, and that nobody's right sure exactly what they mean and how you can establish what fair value is, because ultimately, when it comes down to it, if you don't know where fair value is, you don't know where a discount to fair value is, or you don't know what's expensive to fair value. It's very important from a trader's point of view that you are consistently buying below fair value and selling above. Does that mean you've got to always be below a profile POC to be a buyer? Well, of course, that would seem to be, on the face of it, to be what is suggesting to be true, in which case you're always a fader and never a trend trader. So that seems to be a very unfair way of defining fair value. But one of the things we've got to do is we've got to think about what the basics are of market making for fair value, first of all, because ultimately just about every other trade you take is going to be against a market maker in some guise or another. Now, there may well be trades against commercials, or maybe trades against other retail traders, but the vast majority of trades are going to be filled against some sort of algorithmic market maker. So when you think about fair value in its very, very simple basic core, and we've covered all of this in our normal classroom, and we do it every single day in classroom, in fact, is that we are always trying to establish what fair value is. Now, obviously, when we're thinking about it purely from a price point of view, from a market maker's point of view, fair value is if we've got an offer here and we've got a bid here, well, fair value is somewhere in the middle. It seems reasonable for everybody to think about that's the case. Now, this would also seem reasonable that if this is where fair value is, this is ultimately what develops out into a normal standard profile distribution. So we can recognize that most of the value is built around the fair value prices. And if a market maker is willing to offer this price, it probably means it's an unfair price for buyers. And if a market maker is willing to bid this price, it probably means that it's an unfair price for sellers. What we end up with is we end up with these very, very low volume distribution areas here and here, and we end up with everybody kind of jamming in amongst the middle. Now, one might imagine that this is a very, very simplistic point of view, but it is exactly right. This is exactly how most of these original models were formed, on the basis of where fair value is. And obviously there's been many, many times when it's been developed past this, way past this. Some of the biggest developments are what we call R squared, and this is one of the subjects that we cover a lot of in the classroom, looking at relative value against something else, looking at whether it adds alpha to your trading, whether it takes away alpha from your trading, of course. And just to recognize that looking at the relationships of several markets simultaneously, and we've often talked about this, that the vast majority of traders trade to try and achieve value, but also they have to understand that there are many more elements of value that they're simply not considering. The one thing that's true is you'll never get every aspect of fair value right. You'll never figure it all out because there's too many things to figure out. There's fundamentals. We talk about the fundamentals. In fact, we had a big play on Friday. The guys will remember we had a big short on soybeans. And the fundamental driver was going to be the report, the crops report coming out on the Friday itself. We suggested many times, in fact, for 48 hours or so, we'd been selling a top edge of soybeans. And then the report came out, and even then there was the nasties done at the top edge. And we'll look at that trade in a wee bit more detail in a second. But in pursuit of fair value, I do not ever trade unless I know I've got a discount to fair value as a buyer or a premium to fair value as a seller. Now, the problem you've got is that what is that based on? Historical fair value or a prediction of a future fair value? Well, of course, it's based on a prediction of a future fair value. Otherwise, you would never buy at higher prices. And we know that as retail traders, the vast majority are buyers at lower prices and sellers at higher prices, whereas that is probably the one road to disaster most people can recognize as true to their own accounts. Most people have tried to find the bottom edge, thought they had the bottom edge, suddenly finding that they didn't have the bottom edge after all, and the market is now trending sell side. We did an exercise, in fact, with some of the interns in the bank many years ago. And this exercise was very straightforward. Every time somebody wanted to add to a losing position, we asked somebody else to add to a winning position. It was an exercise. It wasn't true to form, but it was just to highlight this as a process. So if anybody wanted a fade, the other person had to take the opposite. Now you can imagine that as soon as the market started to trend down or started to trend up, the person that was taking the opposite side of that trade was always making a fortune. They were adding to winner after winner after winner after winner. Their profit and loss profile was, of course, taking out spreads, taking out execution costs, and what have you. The profile of P&L was obviously exactly the opposite to the other profile, which meant they got many, many, many winning swing trades, and obviously not so many losses. Whereas the guy that was fading in the drop or fading on the rally, many, 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 many losses until, of course, the price started to turn, and then they started to get some of their money back, if not all of the money back. When you start out as a trader, you have to start looking at defining a set of rules that start to allow you to put sense into the marketplace. That set of rules can come from many forms, and I think this is the problem with the retail space right now, is that there are many sets of rules. There's the guys from the Elliott side, there's the guys from this ICT side, there's guys from profile side, there's guys from fundamentals, there's guys that only swear by technicals, and the problem is none of them are technically right. None of them are technically all wrong either. It lies, unfortunately, somewhere in between. There is no magical bullet. There is no magical algorithm that some would have you believe. There is no one size fits all in every market, in every time frame, in every situation. We had this fundamental storyline, and we had these fundamental storylines, but inside the fundamental storyline, there is also another narrative. There's a prediction of where fair value is likely to be. But then even if we can predict where fair value is, how much of a discount do you want for fair value? How much of a premium would you be willing to sell above fair value? When does it make sense to take that trade? And should you skew your outcomes? One of the things that we highlighted actually just in the weekend there was this idea of market makers adverse selection, because obviously adverse selection means that somebody knows something a market maker doesn't. And it takes us back to this drawing here. In pursuit of a fair value narrative, the market maker here is quite clearly assuming that neither the buyer nor the seller know anything. These are dumb trades, these are uninformed trades. So the market maker is quite happy to assume a buy at the low edge and a sell at the high edge. The market maker is quite happy to add an extra 5 contracts here for every 5 contracts used, and they're happy to add an extra 5 contracts here for every 5 contracts that are used. The market maker has no sense of an informed trader coming into the markets, or as they would call it, adverse selection. But what if all of a sudden an adverse selection event takes place? A seller does come into the markets, and a seller comes in and says, you know what, I'm going to not bother selling at the top edge with the market maker, I'm actually going to start hitting this price because I think the market maker's got this all wrong. And a seller starts hitting this price. Now, at first, the market maker might not know, recognize, or identify that anything unusual is happening. They may stack the bid with another 5 contracts, and then the sell comes in again and they take another 5. And then they stack the sell again with another 5. They stack more into the sell orders, and they keep pressing the market maker, and the market maker suddenly realizes, wait a minute, I think I've got this wrong. And what we end up with is this concept of skew taking place. The market ends up skewing away from this price. The market maker still has their offer at this price here, but obviously what's going to happen is they're going to pull away their bid down here almost immediately. Now, why are they doing that? Well, because they're starting to assume a very sizable inventory position on the bid here, and they're not so sure anymore that they've got the right position. Now, you guys can see this on your charts. You guys can actually see this event taking place, and we'll show you a picture from Sierra charts that shows you some of these types of things taking place, and we'll show you it from the S&P from Friday. And you can see if you can recognize some of these events that are taking place, and perhaps the idea that there's a story building from a repeated sequence of these events. Now, when we look at this event here, of course, the idea is that the market maker is widening their spread, and the reason why they're widening the spread is to try and mitigate some of the risk of an adverse selection taking place. Anybody that wants to sell now are now going to sell at this price down into the bottom edges here, and the market maker is quite comfortable with the fact that they've now opened the spreads up a little bit. Now, there's obviously one other final challenge to this storyline, and that final challenge, of course, is the idea that if you widen your spreads too much, you'll just never trade as a market maker. The market making world is a very, very competitive world where somebody might like the bid better than you and they start going in for that trade. And obviously you then have a choice about whether you start matching that market maker. It's, as I said, a very competitive world. And obviously this idea of widening the spread, I mean, it depends what happens now at the bottom edge here. So let's assume that the seller doesn't pursue the price any further. What happens to the spread? Well, obviously we can now recognize that this trade is now developed into a simple wider profile from here to here, and that's what the chart looks like. In other words, our chart actually represents this fight of fair value. So we can recognize that fair value has maybe moved into that type of situation. And what if they decided to sell at the offer? Well, of course, that means that the skew ends up like this. We end up with a very, very, very sell-side skew. And the market maker is now looking at this and wondering about how they're going to get away from this bit of business. There's several ways they can. They can keep applying the bid. They can keep applying more and more and more liquidity to the bid, in which case they start increasing inventory risk to an adverse selection event. Perhaps the seller's got another 1,000 contracts they want to sell. How many contracts are you willing to keep adding to the bid before you start recognizing you're on the wrong side of a doing here? So obviously the market maker needs to do something here. They need to try and reverse the risk that they're seeing here by closing off the seller somehow, recognizing that this seller is now going to cost them a lot of money. Now, we've obviously posted in the Twitter, we've posted a couple of articles on the Avellaneda-Stoikov model. It's easy for me to say after a couple of Jack Daniels. This is a model from 2008, and it's one of the throwback models. It's a very standard, basic model. It's not really used in terms of professional trading, but it is a great way for retail traders to think about the marketplace. It's a great way to consider whether the marketplace has these elements, and I think it's a good way to introduce yourself to market making if you were trying to think about the market from a market maker's point of view. Now, one of the things that we can look at is we can look at this first set of columns here regarding key strategies for, first of all, mitigating adverse selection. And there's a few I want you to look at here. Adjusting the bid-ask spreads. Well, this is the most obvious one. We've talked about this one a lot in the classroom. Widening the spread, the difference between the buy and the sell price, to compensate for the higher risk of loss when trading with informed parties. So obviously when you start looking at this trading with informed parties, we can start recognizing that one of the ways you can avoid it is simply to widen the spread. How do you widen the spread? Well, you pull away your bids to somewhere else. You don't give them the chance to trade against you. If they want to trade against somebody else, that's up to them, but they're not going to be trading against you. Now, obviously, you've also got other things here. You've got differential pricing, charging different spreads to different customer segments. In other words, they can do this against size. And as a big order comes in, they could widen the spread. As the small orders come in, they maybe close the spread. The challenge you've got there is perhaps an HFT program breaking up trades into one lots, for example, starts hitting your price, and all of a sudden you don't recognize it as a large order, and then you start recognizing that you're starting to take on a lot of inventory risk again. Now, obviously, what's happened here is it goes on to discuss this concept called information gathering, closely observing order flow to extract signals about the true market price and updating quotes rapidly in response to these signals. So in other words, as a market maker, it's very, very important that you read the order flow or read the tape. Now, you might be wondering, how does this affect me? Well, because if you can start following this process, which is really easy for retail traders to do. In fact, most of the guys in the room that we have at the moment, this is exactly what they do, is they track these stories. They track these stories through different mediums. They track it through the limit order book. They track it through the market delta. They track it through individual indicators that show an increase in speed of the indication coming through. So in other words, we call it the voltic, the volatility and the volume of the tick indicator itself. Sometimes it's on a very, very, very volatile candle. Sometimes it's not. Sometimes it's quite clearly stops. Sometimes it's quite clearly the get-go of a trade, the beginning of a trade. So obviously some of these things are not really that important for you, but the most important in terms of your day-to-day trading is the adjusting of the bid-ask spread. It seems very reasonable, and this is why we move along to this idea here, this idea of the Avellaneda-Stoikov market-making model, and it is a very basic market-making model. So when we read through what it says here, in a real situation is that only one side of the order is filled and the other side of the order hangs for a long time unfilled, and thus has to be cancelled. Now, what happens here is that if you've got a bid and an offer in the marketplace, then if there is an adverse selection, somebody keeps trading against your bid, and then another order trades against your bid and another order, well, what's happening to your offer? Nothing. Nothing's actually getting filled there. So you're not able to balance your book. You're not able to mitigate your risk or indeed actually take the bid offer spread. Even by going mid-price, you can't even get the bid offer spread out the marketplace. So this model concludes that the market maker should no longer position the bid and ask prices symmetrically around the mid-price or fair value. So what does that mean? Instead, they should lower the bid price. Well, that seems to make sense. Now, this model goes back to, I think it was 2008 this paper was written. So it's not an old model, but it's equally not a brand new model. But if you think about what was said here, this is an academic research paper, and it's telling us that simply if you start seeing a lot of sales coming in, you should reduce the bid price. No shit, Sherlock. So that it becomes less likely to buy an even more whatever inventory the product is, and at the same time keeping the same ask price. If indeed the buy order doesn't get filled and the sell order then gets filled, your inventory becomes balanced. In short, market makers are responsible for liquidity provisioning in the presence as well as the absence of informed traders. Now, obviously, as I said, there's also a competition by other market makers. They maybe don't have the orders that you have and maybe have read your orders getting taken and they've been already pulling away, leaving you kind of isolated at one single price. Now you've got a choice to move below those guys because they've maybe pulled their orders away already, and you've got a choice to either go in front of them, go on top of them, or drop behind them, depending upon your inventory reliance. And if you've got a big inventory to get rid of, this is a great thing. If you're trying to build an inventory position, this is a great thing. But if this is something that is just happening because of the way that orders are arriving, then of course it's a bad thing. Now, obviously, what happens a lot of time is everybody's trying to figure out who this guy is that's on the other side of the book. Does this guy really know something? And because of the size, perhaps there's a very good chance they absolutely do know something. So when you think about this, what is this actually suggesting? In particular, that if we are contracted as liquidity provider for a given exchange, we've agreed to constantly provide quotes on the market, whether we've been adversely selected by informed traders or not. What should we do under such a circumstance? If we can try to fill such duties but participate in free will market making, what should we do when being attacked by informed traders? Now, what would you do? And this is something we often pose to the guys in the room. What would you do if you were in a market maker situation with these? Would you pull away the bid to such an extent that there is simply no chance of you ever getting any more orders? Or would you decide that if I can get a few more contracts in here, how do you make that decision, in other words? Well, there's many ways to make this decision, interestingly enough. Many ways to make a decision that actually makes a wee bit of sense. Now, when we look at the actual understanding of the model itself, the model addresses two primary concerns of market makers. It addresses the inventory risk management and the optimal bid-ask spread. So obviously there's a typical formula that you can calculate these things out with. Not that you're going to have to ever need these formulas yourself, but it gives you an idea that this is something that a lot of people take very, very seriously. When you look through these ideas, when you're looking at inventory position deviation, when you're looking at inventory risk tolerance, when you're looking at the remaining trading session time, in other words, do you have an infinite window to adjust according to your inventory, or do you have to adjust by the end of day session? Now, we know that from a couple of staff papers from the Federal Reserve that this is a talked about subject, a very often talked about subject, about market makers having big inventory risk going into the closing bell where the liquidity dries up to zero. So this is a really big problem for market makers, is how to balance inventory before the end of the trading session, especially in the markets that do drop significant amounts of liquidity in the afternoon session. And then, of course, it goes on to try and determine the optimal spread, and it goes on to discuss the logic of these optimal spread trading models. Again, you might be saying, okay, this is useful, but ultimately what it ends up doing is it gives you a model that looks a little bit like this. So you've got this mid price in blue, and then you've got the red line, you've got the other red line, which is your ask and your bid. And obviously that's something that moves up and down with the mid price. Now, it just looks like it's just a red and a red line that moves up and down with the mid price, which kind of it is. But how do we get in front of this? In other words, how do we ever, as retail traders, how would you ever be able to take advantage of this information? That seems to me to be probably the key question when it comes to trying to figure out what fair value is in the marketplace. Well, there's many ways. From an order flow perspective, we can look at what they are doing and we can try and respond to what they're doing. From a quant perspective, we can look at the market from a probability point of view, which is what we do through some of the indicators we have, which we call the max spectrometer. We do it through the shakeout indicators. Very easy. And we'll see a couple of examples from the S&P, in fact, on Friday, just how easy this process is. There's also another conversation that takes place in these articles regarding something as simple as the rate of change. When the rate of change reaches a certain threshold, the market making stops. In other words, if the price is moving too quickly, the chances are that that price is under some sort of adverse selection. The market maker stops offering when it's rallying and stops bidding when it's falling during those periods. And that can also be used with regard to the probabilities, which we will touch on as we finish off this classroom. Now, when we're looking at it from an order flow point of view, let's get into the actual practical. So this is an order flow picture. And you'll probably notice at the very bottom of the chart, this is looking at two different depth bid and ask depth bars. You'll notice that one of them is the sum and one of them is the difference between the bid and the ask. Now, one of the things we understand is that if you think about the model itself, what did the model suggest that we should do? If we go back to this model for a second, what did they actually do on the bid here? Well, they pulled it, didn't they? In other words, what happened to the liquidity in this area? Did the liquidity rise or drop? Well, of course, the liquidity, the total liquidity, the sum of the liquidity in this area drops substantially. And as the liquidity drops, of course, what happened to the volatility? So obviously we get a formula, don't we? We get the liquidity versus volatility formula. So as liquidity goes up, of course, what does that do to volatility? Well, usually that means that volatility goes down. The thicker the liquidity on the bid and ask, the chances are the probability is the price will start jamming up into that liquidity and the price will start cycling a wee bit more. Now, obviously, if we go back to the original model where somebody started to sell down into your bid prices, then of course what's going to happen is your liquidity will fall, which obviously means that volatility will do the exact opposite. You'd imagine that volatility will start rising. Now, this is something that we can all chart. We can all see this. And we can look at this Sierra Charts model, which you've all got access. Well, if you've got any type of order flow tools, you've got access to it. It doesn't have to be Sierra Charts. But one of the things you can recognize now is that if you're trying to trade as a fader, this is perhaps a very dangerous element to the trading, this liquidity falling, because obviously if you're trying to fade a dropping market, it's a bad time to drop. Now, obviously, it's also important that we recognize that whilst liquidity may fall, it may fall because there's no offers and the bids are actually getting stacked really, really heavily, in which case actually below you the liquidity is starting to rise. And if that's the case, perhaps this is just one of those events where we're going to get the obvious bounce and the price reverts back to fair value in the middle. Let's take a look and see if we can spot those examples. So there's a couple of examples here you'll notice. So the first thing you've got to make sure you understand is these areas here. So what are we looking at? The sum of the total liquidity. And then what we can also see here, and this is on an individual candle by candle basis, the sum of the total liquidity on the depth, the bid and ask depth. Obviously in the second box here, we can see that this is the difference between the bid and the ask. There should be some sort of relevance between the two numbers. There should be, obviously you can't have the bottom chart looking completely different from the top chart because they're pretty much looking at the same things but just calculating it in a slightly different way. Now, one of the things that we can recognize is we can recognize that liquidity has a kind of baseline attached to it in the NASDAQ here. You can probably agree that this baseline changes over time. If you go back to the London session, of course, the liquidity in total terms will be significantly lower. And as you go into the US session, it's going to be significantly higher. So this baseline of liquidity here is going to be pretty static as you look at it from this chart, but obviously it's going to be different as you look at it from a more macro view going back over the last couple of sessions. But obviously from a short-term point of view, we're looking at these liquidity areas. And what we're looking at is one of two conditions, these anomalies, if you like. Now, the anomalies are that liquidity drops, in which case we're expecting a surge in volatility. In the other case, we're obviously expecting a rise in liquidity. In other words, these end up running up into the top edge, which means that we're expecting this to be a reduction in volatility. And these are the kind of markets that we can then look for example, from a spoofing point of view. So obviously the spoof is illegal, as you all know by now, but the idea of a spoof, the idea is that when you see a rise in liquidity, anybody that starts hammering big sell orders, but there is thick liquidity, seems to me to be in the process of a manipulation. So when you look at this bid-ask spread here, you're looking at the difference between the bid minus the ask. So if there was 400 contracts on the bid and 0 on the ask, of course, this line would go straight up. In other words, it'd be a lot of liquidity on the buy side of the book and nothing on the sell side. So we'd have a line that would be pointing up. Most people would see that as a bullish storyline. And so it should be. If the market has 400 on the bid and it has 0 on the ask, or 1 on the ask, then of course the chances are that any buy order is going to rip the price higher. A small sell order of 5 contracts with 400 on the bid is not going to have much of an impact. Now, obviously, one of the key aspects here is that we notice that the total liquidity actually rises when this falls. So in other words, what seems to be happening is it's dropping from the bid minus ask. So that means that the ask must be rising. But the total liquidity also rises. So this to me looks like it's probably some sort of grouping of spoof orders. Now you can see this is a 15-second chart. So obviously with the offers coming in here and the liquidity rising, it looks to me as if they're trying to encourage sellers, but they're simply backing it up by keeping the number of bids on the book at the same time. So if you're keeping the number of bids on the book, does that look anything like adverse selection? So in other words, if we go back to our original model here of the adverse selection model, and we look at what happened here, did they add liquidity on the sell side? Well, perhaps they did. Perhaps they added 400 contracts on the sell side in here. It would seem reasonable that they might, because obviously there's now a big drop, so they're maybe adding 400 offers into the marketplace here. But obviously the idea that they have just kept the same bid here is wrong, because what we've already discussed is you pulled your bid from the bottom edge. So obviously if you've pulled there's no plus 400. There's potentially minus 400 on that side now as well. So what's happened is you've ended up with a minus 800 starting to show up on this. So obviously, when you look at that, of course, this means that perhaps if you originally started with 400 contracts on the offer here and 400 on the bid, so let's assume we'll just do the numbers rather than pluses and minuses, we can recognize that if we've got 400 on the offer, 400 on the bid, and you add another 400, then of course this now goes up to 800. And if you take 400 off this one, it goes to 0. There is no liquidity on the bid at this price. So obviously if I am bid minus ask, what did we start with? We started with a 0. And obviously if we're bid minus ask, what have we now got here? Well, we've now got minus 800. So obviously if I was to chart that, what would it look like? Well, of course, the amount of liquidity in total terms is actually the same. The liquidity in total terms hasn't actually changed, has it? The trade size is the same size, but obviously what's happened is we've got this big drop phase on the sell side of the book. So bid minus ask is 0 minus the 800 contracts, which means you've got a minus 800. Well, this is quite useful because obviously we can recognize also that this is what's happening in here. It seems as if they're pulling away the trade, but obviously what's also happening is the amount of liquidity actually is going up, not down, suggesting that whilst they might be adding some sells, they're not pulling away the bid either. They're not pulling away the bid. So obviously if they're adding sells but not pulling away the bid, to me it seems as if, well, that might be one of those exact examples where you're thinking about the fake out type trade. They're faking the offer, which looks great because there's a lot of sales coming in from your limit order books, from your various platforms that have heat maps. But they're not pulling away the bid. They're not pulling away the bid at this price. And this shows quite clearly that that is the case. So this looks like they're trying to spoof sellers into the market here with a view of perhaps looking to try and turn it around and go long into this phase. Turn it around and go long. It turns out once you've now seen this, that the price then rallies. Now, it's not a bad rally. It goes from 210s to 260s. It was worth $1,000. The time in the market was probably around about the 35 up to around about 42. You're in the market for about 7 minutes. And you managed to make about $1,000 just back to session or swing highs here. Not a bad little bit of business from a unique circumstance in those areas. Now, obviously, one of the key aspects to any model that you're building when it comes to fair value stories is you're trying to recognize the idea that fair value is a probability. Trading the current fair value, you'd simply be looking at the current bid and the current ask and saying, what's the middle price? Does the middle price have a skew on it? And what am I going to do about it? What we're trying to do is we're trying to recognize what the market maker model is providing us with regard to fair value. Now, on the other side of this trade, you'll notice that there are a couple of trades that drop the liquidity. So you can see that the sum of the liquidity drops here, and you can also see that it's on an offer. Now, that does look like adverse selection, because obviously what's happened here is that the normal amount of liquidity has suddenly gone sell side, and they've also dropped the amount of liquidity, suggesting that they've pulled away the bid, albeit perhaps temporarily, suggesting to me that this trade here has an adverse selection attached to it. Now, as a momentum trader, that's the kind of trade I'm going to be interested in, assuming everything else is right. So I can look at that and say, right, well, I'm going to try and work on the sell orders here. I'm going to try and keep that press going, obviously with the view that we're going to be running perhaps that liquidity there. You can see it comes in again, but at this time it's at the very, very low edge of the session here. Perhaps not the ideal place to start playing this. You can see on the other side of it, you can see that we get an interesting situation here where it seems as if they start stacking in again here with a quick flush to the downside here and then back into the stack again. So they're adding liquidity on spikes here on the bid against the ask. So you can obviously look at that and say, I think they're probably going to try and jam up this price for a while. They're going to jam up this price. So you can obviously start recognizing that this is probably going to be a low volatility area. You could recognize perhaps that they're trying to encourage some buyers to come in by doing what they're doing. By doing this phase here, they're encouraging buyers just the same way as they were encouraging sellers by doing this phase. They're encouraging buyers by doing that. They're stacking some liquidity every time they do it. And obviously that idea is, well, what are they doing? They're stacking the bids, but they're absorbing, they're not withdrawing liquidity, they're stacking, or alternatively keeping the offer with the same size, suggesting that they are bearish, at least for the time being. So obviously the price does then break out to the top side and it goes straight back into a sell. Now the second phase that we see is almost identical to this big first phase. We can see that this side here, the sum is rising significantly from the average. And again, it seems to be all on the sell side, suggesting that there is a lot of sellers trying to spoof the market. There's a lot of sell orders trying to get people to sell it. Now, you might look at the delta in the background here and say, well, I can see why they're trying to get people to sell it, because there's a hell of a lot of buyers coming in. So they're trying desperately to get some of those guys off the numbers. My opinion seems to be that this would be possibly that they see this guy here possibly as adverse selection. So they're trying initially at least to get the market to rotate back down towards bottom edges, and they're going to try and do something with their inventory as it drops here. Seems as if that decision was correct, because obviously when they get to the bottom edge, the buyer comes in and the price then rallies away from that price. And one of the things you'll start noticing is that these events get less and less as the day progresses. You can go back to the cash market open and you'll see an awful lot of these events taking place on pretty much every single candle for the first half an hour, sometimes for the first 45 minutes. We'll certainly do that, but at the moment we're just scrolling forward through the course of the rest of the day. Now you can see some adverse selection events taking place. You can see that this looks like an adverse selection event taking place here. You can see the liquidity drops. It's going mostly on the offer. You can see that here. And obviously that looks like there is an opportunity to perhaps trade a skew trade opportunity. Now obviously it would be an idea to look at that and say, let's see what it actually is doing. So what candle does that take place on? Well, you'll notice that the candle that it takes place on is the very next candle after that big up candle. So what exactly are they doing? Well, they're obviously dropping their liquidity on this candle here. They're dropping their liquidity on the next candle, but it's all going on the sell side. So in other words, they seem to be stacking the offer and they must be pulling away the bid. And obviously it seems as if because they've pulled away liquidity, that there seems to be an adverse selection event taking place here. This adverse selection event to me looks like it's another sell trade opportunity. And in that location, that would be a great place to get a sell, wouldn't it? So this trade shows up as a possible trade there. This trade here shows up. It's at a great pullback price. It's running some liquidity into stops here. So in other words, they're getting the liquidity they want. You can see the delta in the background here is very bullish. They seem to be stacking on the offer side. They seem to be taking the offer side here. For the first time in this whole entire period, it seems as if they're really starting to push the storyline to go short. And you can see that this sell came in at 260s, and within a quick blink of an eye, we were trading at 210s for another $1,000 profit. A simple trigger at a great pullback price. And yet you're seeing that by simply recognizing some of these order flow clues, what's happening is you're making a prediction about fair value shifting according to the market makers. Not based on a model, but based on the reaction of what they're actually doing at certain prices in real time. No lag. No lag at all, because this is real time. You can see these orders arriving. You can see the spike. It's coming in. You can recognize that these are things that you can see as it happens. And that sell did continue, sir. Look at the size of the sell, 260s to a low price eventually of 160s. And what happened when we started to reach down to 160? Well, you can see the volatility started to increase dramatically with the adding and subtracting of liquidity. Initially, sell side, and then laterally, you can see that there was a change to a possible buy trade coming in just here. So that's one candle off the low price there. That's just into that 180 price point. You see that this seemed to change from a sell side, getting pressed into the bottom edges until we got about a $2,000 profit. And then, of course, a buyers came in here at 170, 180, and the market makers recognized that that's the case. Remember, a spike higher, which obviously these did spike higher initially here, suggests that we are reaching a level that is probably going to start jamming up the marketplace. An increase in liquidity, an increase in total sum depth and depth of the bid and the ask is a low volatility event. It's a rotational event. So when we see these events taking place, you can see them taking place here. You can see that there is a big increase in total volumes there. Well, that suggests to me that this is probably going to be a low price for the time being. It would seem reasonable that if the total liquidity was rising, that the price will stop moving. And as the price then adjusts heavily, quickly, and it all seems to be getting stacked, in this case, on the sell side, then, of course, what you're now looking at is you're now looking at a market that seems to have a very high probability drop attached to it. Reading those pins. Now, there's a big question, of course. Can you read those pins? Is that clear? In the right location? Because a lot of these candles will be fair value candles. The event has already taken place. So in other words, if you look back at this event here, you can recognize at the far left-hand side of your screens, you can recognize this buyer coming in here with a low volatility, a low liquidity event, which is a high volatility risk event. But it's already in the market. It's already spiked higher. And therefore, the chances are that that might be a stop run, for example. It might be simply an attempt to try and get liquidity. And then, of course, an opportunity maybe to sell it if the liquidity starts to thicken up at the top edge, which you can see it does do. Liquidity does start to thicken up. And you can start seeing that the bid-ask spread actually starts to drop predominantly from the high prices, and it starts to pop quite heavily to the downside, suggesting that this market probably is going to start cycling back off these high prices. This is something that every single one of you guys can see. Every one of you who has an order flow platform of some description has the ability to do these similar type programs, these similar type events. But do they become predictive? Can they give you an edge by recognizing what the market maker is doing, what the market maker has done? Well, that's obviously the biggest question of all. So let's scroll forward into Friday afternoon session and see if we start recognizing the big change. So we obviously had highlighted this bullish change to this storyline here with a very skewed event taking place here. Well, you can see that if you did buy into the 180s, that also rallied for another $800 profit, which is pretty good. You can see, however, we start seeing a sell opportunity here with another low drop, a big drop in the total liquidity, suggesting that there is a lot of risk now on the sell side of the trade. A lot of risk on the sell side. You're going to be looking at that and seeing if it's a thing that you want to maybe take advantage of. And if you then sold into that, you can see that you've had a couple of nice attempts from that price, knowing that this exists already, suggesting that the market maker has seen. Remember, these are usually HFT events. So a lot of people say, why are they always pins and not candles? Because the chance of it closing on that point is pretty slim. These are 100th of a second type events taking place. Remember, this is a 15-second chart. So the chances are perhaps 1 in 1,000 that it's going to close at exactly the low price. So one of the things you start noticing is this risk event taking place. And you'll also notice in the background that the liquidity had been obviously very, very clearly dropping during the drop phase, suggesting that the skew was probably going to keep going quite hard. And then when the price started to rally, look at the increase in total liquidity, suggesting that the market's getting thicker, suggesting at that stage that with this skew showing a short, that there's a good chance that this price will probably rotate off the 10s, off the 15s, and you should make some quick cash on the sell side. Well, do you? Well, you did. The price actually dropped off really quite nicely, didn't it, at that stage? Now, obviously, one of the other things we start recognizing is we start recognizing what the total delta is doing. Now, we recognized over here the total delta was getting absorbed on the uptick. And because the total delta was getting absorbed on the uptick, the market makers are assuming a short inventory. They're assuming a short inventory, which turns out to be one of those model requirements of inventory size, wasn't it? It was one of those model requirements that why would the market maker assume a short inventory? Why would they add liquidity into that storyline? Well, because they obviously believe that there is no adverse selection on this side of the book, and they're willing to take on that risk of adding to inventory size during this period. They were right. They made a $2,000 swing. Now, it's not every candle that gives us that information. Of course, that's something that we try and establish by looking at other things. You can see, for example, here that there is a bid that seems to be adversely selected. You can see there that that trade goes absolutely nowhere. But again, you can see with the amount of inventory coming in, the amount of actual buy orders, it would be seeming, as far as I'm concerned, to be very unusual that the market maker wants to go long at that stage. And instead, even if they did have a worry about the buy side, that they would jam this price and at least try and take it back down to the bottom edge. We then see a sell order coming in here. We can see that adverse selection on the sell side. And of course, one of the things that we can start looking at is that little stage there, as we'd imagine that there might still be more selling coming in, trying to take over this bottom edge here. Now, as you can see from the chart, that selling turned out to be true. So even if you made a mistake and decided to buy into this spike higher, with all these buy-side deltas, which the guys in the room will tell you we would never do in a million years, even if we're bullish, we'd still be bidding the low price here. But even if you did take it by mistake and you got it quickly stopped out here for a loss, you've more than made up 2, 3 times, 4 times the size of your loss by that simple drop there. There's a lot of money in that. It went from 170s to a low price of 120s. That little drop there was worth $1,000, which is pretty good. So when you see this little passage of play, one of the things you'll start noticing is if you look at this area here where it quite clearly becomes very bullish, you can see these positive bullish events here, here, and then again here. You can see the low liquidity levels here suggesting that the market is going to become very, very slippy on the buy side. So very slippy on the buy side of the trade. So if you're long, you're going to get the benefit of that asymmetrical upside. So in other words, it's going to be very slippy above us based on what we seem to be seeing from this adverse selection event here. So we can again look at it and say, right, so this is the bid is increasing, but the liquidity in total is falling and spiking lower, suggesting that that increase in the bid is with a drop in the liquidity on the offer. Well, that's good news, because if that's the case, we can then look at that and say, right, well, of course, that means that we're seeing an adverse selection event, and perhaps bidding into this area here would make a lot of sense. Well, if you did bid into this and you started to pay 155, 160, you can see that the next phase of your trading, which was then backed up by another adverse event here, you could then look at if you bid 160s, you've already made yourself over $1,200 on the rip. That trade only went on for about 4 minutes, and you've already managed to trade into an area that you're already very familiar with, because you've already highlighted this area in the past that had some adverse selection selling coming in from over here. So when you see this, you see there's an adverse selection event here. You can recognize in this area here, there seems to be a added liquidity storyline, quite a strong added liquidity storyline here. And obviously what you're looking at is, well, where is it? Well, you can see it's on the buy, so that means it's going to be a sell. Because if they add liquidity, but they also spike it higher on the added liquidity, you can start to look at that and say, well, realistically, that means they're probably trying to get some buyers in. Well, you can see the number of buyers that came in during that phase was huge. But they've obviously absorbed that selling, and they've came back against this trade off the 200 level. Well, you can see it's already dropped to 150, and then it's dropped to 130, and you can see some changes taking place. So there was a sell followed by the possibility of a buy trade off the bottom edges here. So when we look at these little quant events, all of a sudden it seems possible that even from a very basic process, and the basic process we're talking about here is order flow, even from a very basic process point of view, we can gain an edge because of this event taking place, suggesting that we can recognize where fair value is shifting to. A drop in total liquidity suggests that fair value is shifting. A spike in the bids, obviously, and or a pull in the ask, whichever one it's taken, suggests that the fair value is going higher. So a drop in liquidity and a spike in this area here, suggesting that fair value is going higher, suggests to me that all of these 4 events here are bullish events. Well, if that suggests that all of these events are bullish from an order flow point of view, does it not seem reasonable that if we look at that chart and we look at what happened during that period, you could have made yourself some really nice money from that simple little takeaway from the bid-ask spreads? Let's quickly dive back into that theory to make sure that you're understanding this properly. So when we're thinking about the idea behind this, we're obviously looking at this as a storyline about how you've pulled. Now, obviously, this idea here of the price going lower and the skew going lower, what actually took place here in terms of the liquidity? Well, we already established the liquidity was quite clearly sell side. So if I was to chart simply the ask liquidity, and obviously we're looking at it as a bid minus ask, then the amount of ask liquidity must be dropping down aggressively, spiking down, if you like, temporarily on that move. What happened to the bid? Well, we recognize the bid went from 400 to 0. So the bid liquidity, which is, if this is the 0 point, well, the bid liquidity also dropped, because instead of the ask, dropping sell side, the bid liquidity also moved lower, didn't it? The bid liquidity also moved lower as well by the same amount. When you add the two of them together, you get this big spike to the downside, suggesting that fair value is significantly lower. A simple look at some numbers on a screen would allow us to make that conclusion. If I said to you that the bid price was 10 and the ask price was 20, and I said to you, okay, well, what's the fair value price on this? Well, assuming that you're quite happy that there is no adverse selection events taking place, the fair value price is quite clearly 15s. If the fair value price wasn't 15s, why were you in the first place? Why were you offering 20s? Why were you bidding at 10s? Because obviously if you're bidding 10s and fair value is 5, what the hell are you bidding 10s for? Because you're just going to get absolutely annihilated if you're bidding 10s. So if we recognize that that's where fair value is, and all of a sudden we've pulled away this 10, we've left the 20, but we've pulled away the 10 to 0. All of a sudden, where is fair value now? Well, it's bid at 0, offered at 20, fair value is now 10. So you can see that by spiking this price in this area, that fair value has moved from 15 to 10. And as the fair value drops from 15 to 10, we can obviously recognize that that means that the idea of bidding in here, perhaps, the widening spread, the size of the spread widening, of course, if you're 20 offered and 0 bid, volatility has quite clearly increased by 100%. The original bid-ask spread was 10 ticks wide. Now the bid-ask spread is 20 ticks wide. So the volatility has indeed increased as the liquidity drops. So the model proves to be true. The model thesis is correct when you're thinking about it from this point of view. Well, we've also established that by simply looking at a few examples which are printed in real time on a 15-second chart or a 1-minute chart or a 5-second chart if you wanted, that these real-time examples seem to, on the face of it, lead to events that do predict what's going to happen next. Now you might be saying, well, a period of about an hour on a 15-second chart on the NASDAQ on Friday isn't exactly a world-class opportunity to see the statistical probability of this, but you've got to start somewhere with these models, haven't you? So when we look at the underlying story, you can see, for example, here, we get the same drop-off in the liquidity, which suggests that we're going to be getting a volatile event, and it's a bullish volatile event here. So obviously we can go into that and say, well, we've already had the spike higher, so I'm not getting an edge to that. But it'd certainly be something I'd be paying attention to at the bottom edges. Likewise, we get another one-off event here, and it seems to be spiking lower, and that's on this green up candle here, suggesting that the upside is a little bit, perhaps a little bit, not that one there, a little bit on the downside, and perhaps, but obviously these are one-offs, and they keep on changing direction. What we're trying to do is establish a uniformity to these trades and also a premium to these trades against other things. You can see another big sell order coming in at the top edge, but it's obviously got a buy order here with a drop off in volatility. And again, looking at that as a storyline, you can recognize almost immediately that this is again into a top edge price. Now that means that you can start to build models around this. The model, of course, that you're building around this is this idea that when you're looking for these elements, there's also a price aspect. So if we go along to where that model came into as a buy, it was on that candle there. Well, I don't think most people are going to be a buyer on that candle. But even if you were, you still managed to squeeze out about 10 points. It's only $200, but it was 45 seconds in the market perhaps for $200. I mean, you still made a very short-term edge on that trade. And sometimes for a market maker, that's absolutely do-fecking dandy. Looking at the underlying shape of these things, of course, there's a couple of really interesting examples at a very low price. You can see we've had now 2 buy trades with low liquidity scenarios building. Well, 2 buy trades with low liquidity, with these drops off in liquidity, 2 buy trades in these areas at a swing low off the 25090 suggests that this could be perhaps a session low at this stage. And obviously, if you were then to buy into that as a session low, you can see that we then get a series of 3 buy trades, again, all looking as if they're adverse selection here, allowing you to stay long during this really dangerous period somewhere in the middle. Well, you've just went from 25090 to 25190. You've just made yourself another $2,000 profit by simply seeing these original 2 situations at a bottom edge, which looks pretty good. Now, obviously, when you look at these models and you start recognizing the value of this fair value story, it doesn't necessarily mean that fair value is going to continue endlessly in the direction that you're aiming for, but at least it's a good starting point for a discussion. It's a good starting point for your model building processes. When we trade from a quant point of view, we try to take out as many of the unknowns as possible. We try and model the unknowns as much as possible. And obviously that leads us to the idea that there can be other factors impacting on the price of our product, which suggests that we should take a quick look at this soybeans trade from Friday that we got involved in, which we actually had a long discussion about in the room pretty much all day Friday. And this was a trade on Friday here that we can recognize. Now, one of the things we were talking about was this massive wholesale price level. The 1150 wholesale price level is a big wholesale price on the soybean market. So with that big wholesale price in the soybean market, we'd started to discuss the normal distributions. You can see that if you were a profile trader, we've got a double distribution higher. So am I above fair value here? Absolutely. But equally, I was also above fair value here. I was also above fair value here. So when you're looking back at the chart, I was above fair value during that entire phase there, wasn't I? So why didn't I sell any of those phases? I'm above fair value, according to profile. Well, that's because the profile is a look back. It doesn't tell me what the fair value is just now. What it does is it tells me what the fair value was, just like order flow tells me what fair value was, and then a change to the order flow, not a change to fair value, a change to the order flow in the Sierra charts tells me that fair value is shifting in a direction that I can take advantage of. If the price is already traded in that direction, well, of course, I can't take advantage of it because I don't know if it's gone above or below fair value at that stage in that snapshot of that one piece of information. It seems reasonable that if they've pulled away the offer and the price has rallied by 20 ticks, it seems reasonable that the price is fully priced in the new fair value narrative, and the chance for me to make any money is obviously now limited. Seems reasonable, doesn't it? But obviously, if I've got a down candle and they've pulled away the offer, then things start to change. So obviously this is dangerous for us to make an assumption based on historical information, and this is the problem with market profile. In fact, this problem was identified by Stadelmeier himself, who then went on to discuss the limitations of profile looking backwards. Well, the tools that we developed in the room with the guys look at a probability distribution that is developing in real time, and we'll talk about that in a wee bit more depth before we finish when we look at the S&P 1 minute chart. So one of the things we can recognize is this chart doesn't rely just upon an order flow story. Of course, there is a wholesale price level here which adds a fundamental aspect to trading. This fundamental being that there is a very, very big commercial entity sitting at 1150. How do we know that? Well, because we can understand the big reason why big commercials will start taking a shot at certain trade markets. In this case, the reason why somebody would sell a big level like this is perhaps because there's an option level, a barrier up here at 1150s. Perhaps the maximum pain is a lot lower. And obviously one of the key aspects to this is, well, what is it that somebody trades when they're a big commercial in the soybeans market? Well, it's quite obvious that what they trade is called the crush spread. Anybody that's in the soybean market, ultimately you can't do feck all with the soybeans, but what you can do is crush them into meal and oil and then sell them as outcomes. It's the same as crude oil. You can use crude oil for nothing, but obviously when you crack it, you can use crude oil for all sorts of different derivative products through the cracking process. You can turn it into gasoline, you can turn it into diesel, you can turn it into heating oil, you can turn it into jet fuel, and so on. So when we understand it's the outcomes, when we notice that the biggest of the big commercials are selling soybeans as part of that process, and we also recognize this massive 1150 level, you'll probably notice that all we did on Thursday was start selling into this, recognizing that they're probably going to cap it. This black line, of course, is simply to remind us that there is a big event taking place, and that event is, of course, the crop reports. You can recognize that with the movement of the black line here, all I'm going to be doing is selling above that. So in other words, this black line technically represents fair value for me. Now, it doesn't matter if it's that angle or that angle or that angle or that angle. It doesn't make any difference. It's not an exact science in this case. It's just an angle to remind us that fair value is dropping. What I'm going to try and do is I'm going to try and sell above that fair value. And it's really easy to do that because all we have to then do is draw a line against where the previous peaks were. Now, why is that useful? Well, it might seem very obvious. It might seem very, very retail-y, but there's a seriousness about it. And that is that commercial operators will buy and sell at key price levels. I mean, they're simply going to trade at day session highs. They'll sell at day session highs. They'll buy at day session lows. It's the normal mode of operation because they know that this is where they get a lot of liquidity. The time of the day is also incredibly important. You'll notice from the volume charts as we come into the US session, the volume starts to increase here. So if the commercials have a requirement for one value, fair value, and two, for liquidity, because there's no point in knowing that fair value is below us if I can get 5 contracts filled at a top edge. What I want to know is if the fair value is below us and I can get 5,000 contracts filled at a top edge. Why? Because there's plenty of buyers up here. There's hedge buyers up here from the options world. There's a lot of people stops up here. There's a lot of liquidity to be available to us to execute against that very passive selling. And you can see that the passive selling takes place in the period where the volumes are very small. Why is that the case? Well, because obviously I don't need to take it higher if I can get volume immediately. So during this period, it's highly likely that the price actually will go higher before going lower. Commercials will do this all the time. They'll take it higher to sell it. They'll take it lower to buy it. A lot of people have tried to hook into this based on their models, so-called models, but not really understanding fully why that would be the case, because there's plenty of models that this isn't the case. You can see what happened on Thursday was almost exactly the same, but in the very high volume session, they took the price higher. Now, obviously, if they take the price higher in the very high volume session, and the value is incredibly bearish, well, it's quite clear that this is only the beginning of an accumulation, not the end. Because otherwise they would just have marked the price down on the big volumes. So obviously when the price jams up in this pullback area here, the idea is that we probably at this stage already know what's going to happen. They're going to run it into a higher price in the overnight session to get sell side business done, and then we'll see if they mark it down the next day. Now, the next day has a catalyst. Now, even when you're right about all of this, something took place on the data that most people can't fathom out, and that is that they got this incredible spike here. You see the spike on the data? So they got this incredible spike that stops out every sucker that's short in this area here with a stop at break even. Now, one of the things that the guys in the room will know, which is interesting, because the YouTube video that Reeve posted of the quant talking about trading is that the vast majority of advanced quant funds of some description do not use stops. And I've mentioned this many times in the room over the last decade or so. We don't use hard stops. But obviously, you know, this is the death of most stops here. Because obviously all the big volume was this area here. This is the biggest US session. So what happens if you're a retail trader in this space, of course, is that you know it's coming into a big event. You're always told by these retail brokers, make sure you've got your hard stop in place because you don't want to be on the wrong side. So all the sellers are coming in at these prices here, and every single one of these sellers is going to have their stops either against that price level, their hard stop there, or they're going to have their hard stop at the prior swing high here. You can see that every single one of those guys at break even or break even plus ones, every one of them gets swept off the numbers on the initial data release, only to see a massive winning sell coming into the marketplace. Now, obviously, if you knew what we know, you would have used that liquidity to get short, not to get stopped out, to sell some more. You'd have used that liquidity to, and this happens on some of the very thick markets like the US Treasury bond market, like the ZB contract. You'll see, and we get a big data release like CPI comes out, and it's a hot CPI print suggesting that the bond price will go down, but then suddenly the bond spikes up, takes out the session highs, and then sells off for $2,000 a contract. Happens all the time. So when you see this type of stop run here, this is the death of most retail accounts, and yet it's the birth of most professional accounts. Interesting how that works, isn't it? So did they go after your stops? No, they just went higher to see what it was up there, get the liquidity for themselves. And if there happens to be stops there, they'll take it, right? They'll take it however way they can get it. And obviously the drop that came in from there is sensational. Have you got to have confidence in your model to do this trade? Absolutely. But the idea of having a hard stop in this market is preposterous. If you believe the model's right, the higher the price, the more you should want to sell it. Because your model's right. And if you don't have any trust in the model, why would you ever sell this in the first place? Why were you already short from the higher price of 51s and 52s? Doesn't make any sense to me if you haven't got any trust in the model. The model only makes money if you keep applying it, if it's got a good model quality outcome, if you've got a very high probability outcome from these models. And that only comes from testing over a long period of time. You're not going to get that with as they said in the YouTube video, you're not going to suddenly get that from just having 3 trades. It's going to be 300, 3,000, 300,000 trades. Eventually, you'll start to recognize the model has a real basis for existing. And then you can kind of fundamentally think about that, theoretically think about those outcomes. You can start thinking about why this model makes sense and why this liquidity area here makes sense and how the trade should be and how the trade can be for you as a trader. Recognizing the short term, the longer term, simply by just drawing the chart together here and recognizing this is a definite sell with a big catalyst coming up, which obviously creates a big risk event. And I don't have a problem with anybody deciding at that stage, look, I don't want to trade this risk event, it's too risky. Okay, so take your money out in cash and then wait for the event to finish, and then by then perhaps you've got a chance to trade, or perhaps the trade's already gone. Well, that's okay. It's just not part of your model to trade a big risk event like this. If that's the case, that's the case. But obviously, when you see such a strong piece of evidence that this is an absolute given that this is going to sell off, all I want to do is sell it and keep selling it. Obviously, this takes us to some of the other ideas that we're also trying to understand when it comes to a value story. So when it comes to a value story, we can look at the S&P market. So let's grab the S&P chart. Now, obviously, on this S&P chart, we've got profile. Now, what's the good thing about profile? Well, the good thing about profile is, of course, it shows historically where fair value was. Fair value, in this case, being the middle of a normal distribution, which is perfectly accurate. But what has it got to do with the future? Well, technically, it's got zero to do with the future. Nothing at all. But it's great looking at where it was and therefore where it's going to, or where it's gone to, and then recognizing that inside of the world of game theory, the probability is it's going to keep going in that direction because that's where the volatility seems to be. But is it because of that, or is it simply that's what you're expecting? Well, it's because of that reason. You're expecting that if the market's going higher, that it'll keep going higher. If the market's going lower, it'll keep going lower. But obviously that would suggest that prices will never drop in a rallying market, or prices will never rally in a dropping market. It'll just keep going. Well, that's obviously not quite true. So what we've done, of course, is that we've brought in this concept again, and it's not our concept. Let's not take credit for it. It's just a normal transform process. And by looking at the transform process, we can look at adverse selection events in real time and how they affect the marketplace. If I take off the profile for a second and we now look in the background, you'll see that there are shaded areas of reds and blues. And as we look at these shaded areas of reds and blues, you'll notice that their adverse selection events happen to be areas where the shade continues on. And what we're trying to do as traders is recognize these adverse selection events. Now, we've looked at the adverse selection event from an order flow point of view. What we're now going to look at is the adverse selection event from a probability point of view, which is what they call a skew in the marketplace. It has this concept called a fat tail event. In other words, the skew is suggesting that the profile distribution is a lot bigger than historically it should be. And that's useful, because if we can get in on that early, we can make a lot of money going with that trade narrative. Now, this is, as I said, this is Fridays. It's not a big look back period. But you'll notice very simply one thing and one thing only. You'll notice that this red event here is running a lot higher. In other words, the normal distribution is wrong. Well, if the normal distribution is wrong, as soon as this hits a red area, it should immediately sell. Immediately sell. Suggesting that there is an adverse selection event taking place here statistically. Through the lens of a quant, we can recognize that this adverse event is taking place and the price is driving higher. Well, I want to go with that as early as possible. I don't want to see a profile building. I have no desire to see a profile building and then seeing that fair value is higher. I am going to create higher fair value because this red moving higher tells me that fair value is moving higher. So when I get a blue event, which happens right here, I'm simply looking to buy into it. And if I buy into that, and then I buy into the next low, I'm in pretty good shape. Fair value, I'm thinking, on this drag higher, I think that is fair value because it never stopped until it stopped. So I now believe that this is fair value. Well, realistically, one would imagine that if you've done any time on profile, if that's fair value, we can look at that area there and say, well, if that's an unfair low, then realistically, according to a profile, it would suggest to me that unfair highs at this stage is up in this area. In other words, there's not likely to be a sell trade until we start reaching up into this area here, even from a normal distribution point of view. Seems reasonable, doesn't it? So what happens? Well, we get a red here, which was slightly higher than it was before. It drops down. We don't get a blue, but that's okay. And then it starts to hit a red again. But look at what happens when we hit a red. Again, it's a lot higher, suggesting that there is still a very strong skew attached to this. And then what happens is it drags its way through all the way to this pivot here. This market is still very bullish. This market's fair value quite clearly has moved higher. So where are we going to buy it? Well, we're going to buy it off the next blue zone. Well, you can already start recognizing the incredible predictive power of this. There's the next blue zone there. So there's your next opportunity to look to buy into this. The same happens on the next red area here. You see it drags its way through to the highest price here. So we're still buying the next blue zone, interestingly enough. And if we're buying the next blue zone, we can recognize that that's the next blue zone here. Now, something happens on the next one which changes my opinion about what's going on. You'll notice that the next red zone finishes here, where the red zone finishes and it turns white. It's actually slightly lower than it was before. Not higher, lower. It's the first time it's happened. If you look back on this drive higher, it's the first time a red zone has actually finished lower than the previous red zone. What the guys in the room know this to be is a normal distribution. The possibility that we're moving to what profile guys would term a normal distribution, suggesting that perhaps if I'm going to buy it again, it's got to be at this price or lower, and I can't start pressing into higher prices at this stage. Well, you can already recognize almost immediately that there could have been a possible buy trade here, and obviously we can work backwards towards where the neutral was. So that buy trade there has also made some money. So that's interesting. So we've now gone into a 1, 2, 3, 4, 5 buy trades using a very systematic set of rules. 5 buy trades. They've all made money. So you're 5 out of 5 big winners. And this has gone from the S&P low price of 67.07s to a high price of 67.97s approximately, giving us somewhere in excess of 90 S&P points or $4,500 a contract, just as a single straight line swing. Obviously there's add-ins, there's takeouts and so on, but you can see that that's the minimum you would have made per contract. So when we look at the neutral zone forming here, one also knows, if you've followed what we've talked about, is that as a rule, the market maker widens the spread. Why do they do that? Well, they're trying to discover how much bidding or offering is available in the market. And we start looking at other tools like volume arriving and what have you. So we kind of already know that there's a good chance that when this buy comes in, even though this is a neutral market, they'll still run up here to see what's up here. And you would imagine as the buyers coming in, we're already establishing it's probably going to run down here to see where the trade is likely to go to see how much demand there is or supply there is. When we do run into the top edge, you'll notice that there is a very large arrival of volume in this area here. A very large arrival of volume suggests to me that that's the unfair high developing in terms of a profile point of view. Seems reasonable. We're kind of disregarding this blue at higher prices because, well, we don't expect there to be a buy at higher prices at this stage. We've already established that this is a neutral profile. Now, obviously, if you decided that this was an extension for other reasons, then this would still be a perfectly valid buy trade in that case. And if it was a perfectly valid buy trade, well, of course, you never lost any money on it. You could simply have made a quick profit into the prior swing high and then scratched out as the price drops back through. As the price starts to make lower lows on the blue, the market is effectively telling us that the trend is now changing. Fair value is now dropping. And as a result, because we're now moving through the blue areas and blues are now lower, we can start selling with confidence the red area when the red area appears. How did that do for you? Remember, this is not repainting indicators. These are real-time indicators. There it is there. There's your first sell there. And there's your second sell there. And ultimately, there's your third sell right there. And how did you do with those sales? Not too bad. You can see for yourself, we went very nicely off the first one, back to the bottom edge. Very nicely off the second one, back to the bottom edge. And obviously, as the third one came in, it didn't quite make it back to the bottom edge. And you can see that we left a blue zone behind, suggesting that fair value, at least in the short term, has actually changed back into a bullish neutral phase. So if we're going to sell it, we're going to be demanding a sell at higher prices. So in other words, we're not going to be using these technical tools of simply, if it runs and touches this level, I'm selling at 75. You're already immediately alerted to the fact that we're going to be expecting this price to rally before we start working back into the sell. And there's a couple of clues here with an arrival of what we call the A10 here, that we might be able to start getting a higher probability on the short sell as that takes place there. Now, obviously, it didn't develop. It just went sideways, and that's okay. You wouldn't have lost any money even when the trend changed. Now, look at those series of trades. This is now no longer just a cherry-picked example. This is a period that's gone from 1,500 hours now to nearly 2,000 hours for 5 hours of activity. We've had a trending phase. We've had a kind of neutral phase. We've had a minor pullback sell phase. And yet we've managed to win 100% of our trades to some degree or another, with almost no drawdown in each of these trade opportunities. Obviously, that still requires an execution skill ability. It still requires a confidence to be there for your charts. But this is systematic trading. This is all probabilities. They're not just red areas and blue areas. These are probabilities. These are future fair values. These are future unfair highs and lows that haven't printed yet, based on probabilities, based on a look forward into the future. It's very rare that you're ever going to see anything quite as good as this. As many traders in here are making, 3 figures, 4 figures, 5 figures, and in even some cases 6 figures on a 10 lot on a day using some of these entries. Now, obviously, that 6 figures in one day is based on a 10 lot type narrative, but you can also understand that the markets are also incredibly volatile, and it's taken years to get to that level. Of course, going forward, it's not something you just turn up and start doing, but you can see the probabilities. I mean, if you're in an uptrend, can you all agree that recognizing that the red line going higher through a red zone means that you're buying a dip on the blue? What a set of rules. So instead of your 19 hours of classroom sessions you've got to do to start picking up trades almost immediately, you can simply start thinking about that phase in isolation. You might say, okay, smart arse. So this market has came from, obviously, let's see if it made any money on the other phase of the drop phase. Well, let's take a look at the prior session from London. So can we see that there is a very large drop phase here? Can we also agree that if the blue line is dropping like this is telling us that fair value is now printing lower. If I see any red areas, I am instantly selling. What about that sell? The blue line is lower. What about that sell? The blue line is lower. What about that sell? Could you have potentially have seen yourself to be making some monies? Now, obviously, what happens on the final one is that it all changes. The blue line actually started to rise here, and we start moving into altogether now a neutral auction. And as a neutral auction starts to appear, we're starting to think about the idea that they're going to widen the spread here, and they're going to start widening perhaps even the spread here. So we're not going to start pressing on a red lower. We might still sell this one because it's at the spread area that we would be interested in, and we could recognize that that might still be a sell. But we know that if we're going to buy it, it's going to be on a low, it's going to be on an angle, and it's therefore this idea of buying on the angle. Well, that still would have been a reasonable proposition right through that entire phase, wouldn't it? Even by drawing a trend line in. You could have been a buyer into that lower price there. You could have been a buyer into that lower price in a neutral auction, allowing you to start picking off trades. And this is just a trend line, guys. This is just a reverse trend line. I'll just pop it into that location there against that location there. There's the buy and there's the buy. We call this the art trade. We covered this in the classroom the other day. Okay, so now we're looking at a series of trades from 11:45, 12 o'clock in London, going all the way out through to the US session. And now we've got a sell here. That's 1 winner, 2 winners, 3 winners, 4 winners, 5 winners, 6 winners, 7 winners, 8 winners, 9 winners, 10 winners, 11 winners, 12 winners, 13 winners, 14 winners, 15 winners, 16 winners, perhaps a couple of scratches. Execution areas, drawing flat lines, execution areas, grabbing some liquidity. And remember, every one of these trades has the ability to be pushed across into your order flow to find some of those order flow clues. So for example, on this drop phase here, just because it goes blue doesn't necessarily mean you start buying it. Maybe you want to wait for a big arrival of a sell order getting trapped or a big arrival of a buy order coming in. So your order flow clues, maybe you're wanting to wait for the liquidity order book to go bid and for the offers to get pulled. Maybe you want to wait for those elements before you take a trade. That's absolutely fine. And in which case your stops areas could probably be as tight as 1 or 2 ticks on the S&P, perhaps 3 ticks maximum. Well, if you can get your stops to maybe 3 ticks maximum, you can see that most of these trades are quickly into profit and a nice stop at break even eventually. You might say, I thought you didn't use stops, but when you've already made a lot of money, stops at break even is the defensive stop, and it's just in case you collapse and die because of the excitement of making wins for a change. Simple process. Done well can be amazingly successful. Now, the good thing about this classroom is we don't just teach this process. This is obviously incredibly valuable because this is pure quant stuff. This is purely from the quant point of view, from a probability distribution point of view. But we also teach, obviously, the fair value from the order flow to recognize that you have fair value. We talked about algorithmic trading that's visible on your order flow in last week's classroom. We'll certainly be covering that in the classrooms coming up. But we also cover it from an R-squared point of view, something that the chap on YouTube actually talks about as well. We've been talking about it for well over a decade now in this classroom. And from an R-squared point of view, of course, we have various models that we can apply to this. And from the various models, we can build out these models and we can look for various other elements that we can actually add to this storyline. We can see where the model agrees, where the models disagree. We can look at certain areas where there might be an opportunity even to take advantage. Now, if I look at a model like this, there's a couple of really important opportunities to play this. Now, this model has a 1.0 correlation, or so it should have. So if this model has almost a 1.0 correlation, it's quite obvious that there are some key opportunities to play. We're in a blue zone here. You can see that this is pointing straight down, so the probability is high for a buy. But look at these candles here. They're bullish. So if I was to look at this area from a quant's point of view, I'm looking at what we would call R-squared opportunity. There's an R-squared opportunity to buy into that. The probability is getting higher for the buy. Black line is dropping. And also the model is starting to tell us that this is a great probability for a trade to the upside at this stage. Now, obviously, these are types of models that you might be interested in. These are the types of models that some people use, some people don't. Some of the models are different from others, of course, and we can start looking, for example, at a massive sell opportunity into this, what we call the shakeout phase here. We could look at that there and say, right, I'm going to absolutely get involved massively in the prediction of the market at that stage. During that change in the phase here, we see a big change in the phase here. Now, obviously, when we look at those types of trades, we can then look at those as tradable opportunities on the screen. And obviously, if I was to sell into this phase here, you can see that this was a drag through and obviously a lower probability trade. But you can see that once we start seeing that coming to a top edge, we look for a volume arrival. We look for a lot of different things. You can see that by the time it reaches into that area, a nice easy opportunity to start calling the top edge. This buy trade on a pullback was equally just as good. You can see that there was a very nice area to lean on in this liquidity pocket. 67.82s, trade 67.95s, we make 13 points, $650 profit per contract. And it's not just one model, is it? It's many different types of models. You know, we can look at lots of different types of models. We can see in here, for example, this model is very bullish here. This model is very bullish. This model is starting to become bullish. You can see just in there, the model becomes bullish on all three models. These are all individual models that are modeling the market from an R-squared point of view. So when I see that storyline forming in there, it's a blue zone. It's at a lower price. I have to be aware of that so we can actually add a normal standard distribution process to the fact that this blue area is not as good an opportunity because of the fact that that sell is brilliant. So we have to be careful about bidding into this phase. Absolutely. And maybe you want to pass on those trades. Don't have a problem with that. But the point is that these models inform. You take a look at this model at the bottom edge here, and you'll notice that it doesn't matter which one. I mean, the most obvious is the middle model here. And if we look at the middle model here, you'll notice that there is a significant change in R squared here. You'll notice that we've moved into a high probability buy event, which is a blue box. You can recognize that the model is suggesting that fair value is rising. That's these blue candles. Fair value is rising. You can recognize the probability of a buy is increasing. And you can start to think to yourself, how can I start getting involved in this? How can I start finding a way into this incredibly high probability buy trade? And obviously you're trying to buy as much as possible on these down-ticking black lines because that's where the probability is increasing in your favor. As we look at that incredible high probability, you'll notice a very quick flash on the sell side here. You'll see that the red candle's starting to fall. We've moved into a pink zone. And from a trader's point of view, there's a very high probability quick short sell opportunity here. When we look at those two trades in a world of very short terms, you'll notice that those two trades result in a bottom edge price here and a top edge price here. You made money by bidding into that very bottom edge there at 55s, and you then made money by selling into that top edge at 75. It was worth $1,000. And then the second trade was worth somewhere around about $800. Two trades, 1 minute charts, approximate period in the market, maybe around about 15 minutes. And you're already up somewhere in excess of $1,500, $1,600, $1,700 profit per contract by trading the other parts to the model process. Now, the market's ability to create models is vast. I mean, we could build hundreds of models of the marketplace to establish exactly what fair value is. The bank's models incorporate hundreds of separate data points with separate data weightings, and these data weightings are just constantly, literally every second, every microsecond, the valuations, albeit very, very small adjustments. So we can't ever get to that detail in the retail space with you guys, but what we can get to is an area where the trade starts to ping off the charts as crystal clear. You'll notice that fair value, for example, on this candle here is bullish here, and it's bullish here, and it's bullish here. So you could look at that candle and say, well, if it's bullish in a blue zone, I'm going to take a shot at some buys here. I think that fair value is at least a little bit higher. And if I was to find a bit of order flow perhaps around those areas, maybe I could find a tradable opportunity. Now, what's interesting, of course, is that this is the S&P, but obviously these ideas cross over to the NASDAQ, and we could look at, for example, some of these ideas here. One of the things that we noticed was this area here became incredibly bullish. You'll probably remember this from 1846 on Friday. This was the NASDAQ. It doesn't make any difference. It's an index. It's a US market index. So from about 1846 here, we started to see these what looks like adverse selection events here. Adverse selection, and the stack is starting to build on the buy side and pull on the offer. We can see it from about 1846 through to about 1849. Now, obviously, if we look at 1846 to 1849, you'll happen to notice that it's the same area as this area here, where we start to see the models turning blue. You see how the model across all three markets, now at that stage, the top model still red. But as we move forward, what happens here? The top model goes blue, this model's blue, this model's blue. What time was that? Look at the time, 1845. And then we look at the next candle along from here and we see that that one's blue, that one's orange, but it's a dash, and that one's orange and it's a dash. And then we look at the next candle along and we notice that that candle is blue, that candle is blue, and that candle's blue. So all candles are blue on this candle here. Every one of them. 1848. 1848 on Friday. A buy trade. 1848, we're in a blue zone. A buy trade. 1848, we're in a blue zone. And then we look at the chart here, we say at 1848, here it is here, there's 1848, we get this skewed look at the marketplace. The withdrawal of liquidity, the drop-off in liquidity is suggesting from an order flow point of view that there is some sort of adverse selection event taking place in the marketplace. An adverse selection event. Who'd have thought that was possible? Who'd have thought that we could possibly see an adverse selection event when all our other models, all our R-squared models, were suggesting that there was an adverse selection event that we could take advantage of? In other words, we're the adverse selection event. We're not responding to it. We're not taking part in it after everybody else is taking part in it. We're taking part in it at the same time because we're seeing it in real time. Another example was what happened at 1812. You know, obviously we can look at the NASDAQ here. We can look at what happened as we moved higher here. You can recognize that as we go into this 1814 area, we move into a red zone. We know that the blue zone had pulled a wee bit lower than it was before, so I do like this a lot as a trade. You'll notice that these areas, these models, have never gone bid. This one went bid here, but on the very next candle at 1815, we see that the model went very offered, allowing us everything going sell side. Now, the two highest probability models is the bottom model and the middle model. So these are the ones that I wanted to see, and these haven't gone bid at all. They've not got a single cent bid. 1813. Look at the times. 1813, 1814, 1815. Let's take a look at those adverse events on the NASDAQ in those areas. 1813, 1814, and 1815. So what happens? So initially, there are withdrawals of liquidity. The bids are coming in. The bids are coming in. And the price keeps pushing higher and keeps pushing higher. So you just leave it alone. Good news. You're able to leave it alone. You're able to recognize that you need to see these other elements before you take a short. Now, that would have meant that instead of maybe trying to sell here, or trying to sell here, or trying to sell here, you could have left this alone until it starts to change around a little bit. And then you can start seeing that with the arrival of liquidity, with this change here, you can see that the thick liquidity on the uptick, you could imagine that there is a nice easy sell trade opportunity here. So instead of trying to sell it on the way up, you could have sold it right there and taken another shot at this adverse selection event slightly later than you would like as normal, but still an opportunity to play. As we trade down into the bottom edge at 1823 to 1825, these adverse selection events seem to be on the buy side of the trade. 1823 to 1825. We look at 1823 to 1825, and that's this area here. Look. Take a look at the color of the candles. The candle goes blue here, 1823, 1824. You can see the blue candle there. You can see the blue candle there. And indeed, you can see the blue candle there on a downtick into the day session low here. And at the same time as that takes place at 1823, which closes 1824, when we look at the market model here at 1824, you'll start noticing that the 1823 is already gone bid here, and then the 1825 goes bid here. All of a sudden, you're either involved in it or you're about to get involved in it. The order flow is telling us there seems to be the market maker detecting an adverse selection event here. And the adverse selection event seems bullish here. With the adverse selection event seemingly bullish, and you being able to recognize what the adverse selection event is here, you're able to tie the two together. And obviously it's all about practice, about getting these things running smoothly, running quickly. But once you've got it, it becomes second nature. You're building into these. It doesn't just happen. You start to see these events taking place. You start to see these events building, and you say, well, there it is there. I wonder if I can get in front of this event, maybe to take a shot at some business. Now, when we go back to those incredibly big chunky events like this one here, where we started to recognize this very, 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 very thick liquidity, we recognize this incredibly thick liquidity here, or we indeed recognize this very thick liquidity here. Obviously, these are the events that should be very easy to figure out, because this lasts for quite some time, 1633 to 1638. You've got 5 minutes to check your other charts to see what's going on here. Now, obviously, when you see this liquidity building, it's not an adverse event, it's a spoofing event. But you've still got a great opportunity to then go at 1633 and say, well, what's happening at 1633? Can I find anything interesting at those areas? So 1633 was this drop phase here. Now, what you probably notice from the drop phase is that this goes blue here, this goes blue here. So you're obviously able to look at that at 1633 and say, well, we've got 2 out of 3 that have gone blue. I'm going to take a shot at it because we're getting a lot of adverse events looking like there's a big liquidity stack, looks like there's a spoof going on. I think I'm probably going to be able to make some easy money on the buy side. This is what R squared is all about. This is what's different between ourselves and the guys that think that technicals alone will be good enough to make money. This is completely in contrast to the guys that think that every single structure is the same as the previous structure. That is what we then look at as pattern trading. That every single fair value gap and order block is the same as the previous fair value order block and fair value gap narrative. The same pullback of 1.3 is the same as the current pullback of 1.3. The previous extension of 1.6 is the same as the current extension of 1.6. That's quite clearly not the case. If you just seriously stop a second and think about that logic. If life was that easy, it would be everybody with, as I said actually in the quant interview, everybody with faster execution would simply be in front of you guys, in front of those trades, and they'd be making a fortune. You'd never get a sniff of those trades if it worked. Therefore, it doesn't work. And it'll, of course, like everything else, it'll work sometimes and it won't work other times. So the most important thing going forward as a trader is the ability to recognize that these models change, the storyline changes, the drivers change, the volatility changes, and what we've got to have is tools that are adaptive, tools that learn as part of the process. We can recognize this distribution increasing, suggesting that we're looking for a buy trade. We can see that this is higher than it was here, suggesting we're still looking for a buy trade. And what we've got to do is bring in the tools that allow us to figure out where fair value is against that story. Because it must be a lot higher than the price we're getting. Because the reason why we know it must be higher is because we can see the distributions. Now, they're not distributions based on profile. They're distributions based on a forecast of profile. And it's quite interesting that when you look back at these areas where we're forecasting a low volume node here or an unfair low here, it's quite interesting that when you look at it, it turns out that we were right. It was an unfair low. Think about the power of that for a second. If we're able to look at a marketplace, and when you see a market doing this, and we start forecasting an unfair low there before even an unfair low is printed here, think about the power of being able to have a profile in real time, an ability to know that if that's an unfair low, that fair value must at the present moment be somewhere here, but probably more likely skewing from there at least towards the top edges. Think about the power for a second of knowing profile unfair lows and unfair highs before they print. It's never really been captured in this way before by the trading community. But if you agree that these things can print in real time, and the guys in the room will tell you they do print in real time, okay, they might flash on and off during the building of this candle because it changes. Of course, it's a candle. It doesn't just stop. It stops at a certain time every time. And when it stops, the color's there. It's fixed. It's now there. It doesn't go off. It doesn't repaint in the future. It's a probability distribution. Whether it's right or wrong, it's still just a probability distribution. But what it's now showing us is that this probability distribution will now be an unfair low. And obviously, if we're right about that, and we recognize that by looking at this, it turns out that we were right that it's an unfair high, well, look at this red zone. Look at the high of the red zone here, suggesting that at least in the short term, is going to be an unfair high. And when you look at the profile, you'll see it is an unfair high. And before this profile is even printed, we know that this is likely to be the unfair low. And then when we move forward, we can recognize the drag higher. So this unfair high keeps going higher. And we recognize that this is probably going to be the unfair low here because it prints right there. So we recognize that that's probably the unfair low. And we can look at the order flow. We can look at the models. And when we know that that's probably the unfair low, and then you look back in history, it turns out it was the unfair low. And because of that storyline, you can recognize that we had predicted that this was going to be an unfair low as well. Well, in the short term, we were absolutely spot on. Now, the profile obviously rallied up to this unfair high, which we already knew about because we'd already predicted that this was the unfair high here. And therefore, you can see that we've not only got the unfair low here, we've got the unfair high here. And as it drops back through again, you can see that this is now predicting that this will drag through. And that's exactly what happens on the next swing as it drags through to another unfair low. So when we think about fair value, and we go back to the original question, in pursuit of fair value, it seems reasonable to start considering that in pursuit of fair value means that we're having to try and predict, not see where fair value was, because everybody can see where fair value was. If knowing where fair value was before is going to give you an edge, then okay, good luck. And I'll see you guys somewhere else. Perhaps at the horse racing track, because that's all it's giving you is a historical view of the marketplace. If previous history was always giving you fair value, you would imagine that favourites would always win and the bookmakers would therefore always lose money. So why did the bookmakers not always lose money? Because Forum is no particular guide as to this race. And of course, according to owners and trainers and jockeys, a lot of horses are held up, as you well know. A lot of horses try and a lot of horses don't try. Some horses just try their hardest and still can't win a race. So in other words, the ability to know where fair value is in the hands of the people who know how good their horse is in a race. The guys that know that their horse is running off a certain weight, but it should be running off a certain other weight, which is a lot heavier, and therefore they have a massive edge. But the only problem with that is there might be 2 or 3 other horses in exactly the same position that you don't know about. So yes, you have an edge on the bookmakers. You know your horse is in good shape. You know your horse is maybe a stone too light in terms of the bookmakers' pricing. You know that your 5-to-1 odds or your 6-to-1 odds are really good value for a stone too light. Price should have been even money or worse. So you're expecting that you've got a massive advantage. But it still doesn't mean that you're going to win the race, because there could still be 2 or 3 other horses that you are not aware of that have a stone and a half in hand. So whilst you've got an edge against the bookmakers, you don't have an edge against these other horses that are about 6 or 7 pounds better off than your horse. And those are the impossibles to know. You don't know that. You can watch the betting patterns to see if anybody else likes their horse. You can see if anybody's putting their big money on their own horse. But of course, that's still not going to be 100% conclusive. In the markets, it's the same. All we can do is start to build an edge against fair value. In pursuit of fair value, it starts with a simple idea of a market maker trying to find a bit of value in the middle of a spread. The market maker that thinks that this is an unfair high here, and the market maker that thinks that this is an unfair low here, the market maker that's trying to get a lot of sellers to trade here and a lot of buyers to trade here, and the same number of sellers here with the same number of buyers here. And if they do, then whatever this is their spread. They'll make money a lot. And if it stays here forever, they would be delighted. Fair value for the sellers is actually probably here, and fair value for the buyer is probably here. The market maker commands that price. The market maker dominates this price. But what if we had an idea that all of a sudden we predict that this is an unfair low price? If we're predicting that that is now an unfair low price, and that this is an unfair high price here, before any of this has taken place, and we're therefore predicting that fair value is here, I'm now able to look at the current price, and if it's here, I'm not trading. I'm not trading because I'm still at fair value. So if the price were to drop down to this price level here, and I'm now looking at a price that I believe is now an unfair low price, and I step in and say, right, I'm taking my trade here. Market maker still hasn't seen that as a situation. The profile guys still haven't seen that as a situation, but I have, because I now recognize that that is an unfair low. This is fair value, and this is the unfair high price. And even if I can just get to fair value, I'm probably going to run the stops of the top edge here. I'm going to get some liquidity, and maybe there's going to be a bit of a pop on this, at least temporarily. So is it possible? Well, you tell me if those blue areas were good for buying. If this blue area here was good for buying. If this red area here was good for selling. If this red area here was good for selling. If this red area here was good for selling, or if this blue area here was good for buying. If you can tell me that these areas are good for it, then the answer to the question is, yes, you can have an edge. You can establish that when I sell this price, I believe that fair value is below that line, or possibly on the line. But that's fair value, not an unfair low. Potentially fair value. Now, if it's fair value, it might be a profit take opportunity. If it turns into a buy trade, we'll get a chance to maybe buy it, because that would mean that we're changing our opinion about fair value. But it turns out we were right. The sell here suggests that fair value has shifted lower. And we can actually recognize using a simple trend line how far we think fair value has shifted, because we can then join the dots in these areas, and we can recognize that fair value has probably dropped by about the same degree. And therefore, as a profit take, we might be working into those areas. If you believe that knowing in advance where fair value is could potentially give you an edge in your marketplace, there's nowhere else in the world of trading online that is going to tell you this or show you this. That's one of our unique points that we do. We build these models, and there are several of them. We'll build a model for oil. We'll build the model for natural gas. We'll build the model for soybeans. We'll build the model for bonds. We'll build the model for the FTSE, for the NASDAQ, for the S&P. We'll build the model for the, what have we not said? Soybeans, we've done that. Copper, we'll build the model for copper. We'll build the model for pretty much most of the main commodity markets like gold, silver. Once we start building these models, you start to recognize the world from a professional's point of view. The concept of value, the concept of understanding value and trading value, real tangible value ideas. The concept of understanding the withdrawal and adding and stacking of liquidity. The idea of where order flow fits into all of this. The idea that if you can start building all of these edges into your trading, then a lot of other things start fitting in. Your market structure ideas will start to fit in with this. Your idea of what a historical profile looks like is now being predicted on the right-hand side, where you can see double distributions higher or lower. You can take advantage of them instead of just seeing them in hindsight. You can actually trade them. You can become the double distribution lower by selling what you now know is a predicted unfair high price on a pullback. Just as this area here was a pull back into an unfair high, a pull back into an unfair high. And if you were to look at that as a distribution process, you recognize it as a double distribution. You've gone from a swing high here into a double distribution lower. And we predicted the unfair high here. Now, you may say technically that was an easy one, but was this an easy one? Technically? Probably not. So you can recognize that whilst there are some that are very obvious for the technical guys to say, well, it's just the same as technicals. Yeah, but okay, so what about this one then? How would you have found that one? Oh, well, that's a 50 pullback. Well, if that's a 50 pullback, would you not therefore have used that rule to sell here and therefore lost a lot of money? Of course you would have. So in other words, you can see that this process is adaptive. It learns based on the volatility that's coming into the marketplace. It starts to translate into these areas that we can start to recognize with a high probability are likely to reverse the marketplace. From that, we can start making great trading decisions. From that, we can build our order flow models from. From that, we can build our R-squared value models from. The language of our room is completely different from the language of any other room. It doesn't have the market maker's model in a way that it's a accumulation, a markup, and a distribution, although we do have all of those elements as well. It's not about just the volumes, the order flows, or the values. It's about all of these and how they interact with each other. It's about fundamentals. We don't believe that everything is based on technicals. We don't believe that everything is based on fundamentals. The answer lies somewhere in the middle. Sometimes it is fundamentals, and sometimes it is technicals. We talk about convexity on bonds. We talk about DV01s on bonds. How many other people talk about convexity and DV01s? How many other people talk about statistical arbitrage and the movement of pension fund information between the FTSE and the S&P? How many people look at those? How many people look at the peer groups across the gilts markets and the bond market for the bond valuations? We do. So these are all things that we cover in the classroom. These are all things that we do every single day, in fact, in the classroom. The format is a lot of the times responsive to what's been happening. The format, of course, is always responsive to some news that maybe comes out. We are never immune to those events, but we've also got to make sure that we're understanding that these models can become very systematic as well. You can see that some of these sell opportunities can almost immediately become short selling opportunities here, or this buy area, as it runs into that bottom edge liquidity if it hasn't already done it. So that little run into liquidity you could have been buying in here, but it still requires an execution. Still requires for you to find the order flow lean perhaps, or the candle reversal if you don't have access to order flow. Still requires the buyer to show up so that you know you're not the only guy in town that's buying the drop phase. Once we understand those elements, once we understand the idea that we know or we are forecasting where fair value is, and we build confidence about it, then of course what you're now trying to do is execute. Get better at execution, get better every single time you press a button, every time you take a trade, the confidence builds, and you start seeing the outcomes. You start saying, this is making sense to me. You start relying, for example, on this A10 because of the weakness on the sell side. The A10 adds an extra component to that trade, allowing you to then say, right, when that candle finishes and it's got an A10 and it goes higher, I'm selling into that storyline. It should make sense. The A10 is this little red signal here. It's just the same way as the green A10s at the bottom edge here. When that candle finishes, they can ultimately repaint at that stage. So all you're waiting for is the price to drop below it for the A10 to still be there and for a possible buy trade reversal. Now, you know, these are things that you might want, you might not like. It doesn't make any difference. They are there for you to see. They're there for you to think about. Now, obviously, if the market is driving very hard through a driven area like this, I probably would not be relying on any A10s. The only A10s I generally rely on is if this red one, for example, you look to the left and there are prices above that price. If I look to the left on this green one, there are no prices below this price. I'm not going to rely on this. So these are going to be more likely to be distribution opportunities if the prices have got nothing directly to the left. Something you'll learn, of course, if you come into the class. We're going to finish off with that today. It's about fair value finding. The idea of seeking fair value, and it's something that every single one of you guys needs to ask yourself. If I'm trading ICT, or if I'm trading profile, if I'm trading Fibonacci or Elliott, what does it tell me about where fair value is? And therefore, am I trading at a premium or a discount to fair value? If you're trading profile and you're looking at the profile from an hour ago and you're at the bottom edge of that profile, have I got a discount to fair value right now? No, but I do have a discount to fair value from an hour ago. Is that relevant? It might be. Sometimes it will be. And sometimes it won't be. It depends what else has happened, right? The market is constantly shifting. That's the problem. So therefore, recognizing that that fair value might not be relevant anymore allows us to avoid those types of trades. We simply just don't take them because it's not up to date. It's too historical. So profile is a great way to learn the markets, but it's not a great way to trade the markets because of its historical throwback. Your ICT guys, I don't know if they know where fair value is, but what they can look at is a lot of the times they have this concept called a fair value gap. A fair value gap's been around forever. It wasn't established by some God-given algorithm that only the banks know about. It's just called an imbalance that's been around, as I said, forever. An imbalance. The price has an imbalance on the buy side and the sell side. So what is an imbalance? It's a skew. What is an imbalance? It may be an adverse selection event. As I said, it's been around forever, and we've been modeling these adverse selection events before anybody in the ICT space was even born. We just call them imbalances, not fair value gaps. And therefore, we might have an opportunity to play against that arrival of the adverse selection events. But when we look at these ideas, we can actually get in front of those because we can see, for example, these types of events here, where we see some of these liquidity events taking place. We can see a withdrawal of liquidity. Now, that's before the price perhaps sells off, before we get an imbalance coming in. We're able to recognize the liquidity withdrawing in these areas. And we can say, well, if the liquidity is withdrawing, can I maybe take a shot at that as a press? Now, there's not isolated examples. You can go through all sorts of days. You can look at this event here, for example. Look at this adverse selection event, a massive adverse selection event here at 11:37. If you're looking at that massive adverse selection event, it's quite clearly bearish. It's quite clearly adverse selection and a sizable adverse selection. And you're going to look at that and say, I should be all in maximizing that sell opportunity. There's no fair value gap to trade at that stage. And obviously from that trade there, you can recognize that that huge adverse selection turns out to be the exact price where the price then tests in the future. And you get a nice opportunity to start reading that adverse selection event there and going into your other parts of the model and saying, I genuinely like this. I might take a shot at this one. Doesn't mean they're all true or they're all false. It just means you're starting to recognize stuff. It all started with this increase in liquidity here. And you can see that with the increase in liquidity there, you can see it's nearly all buy side, suggesting to me that with all the liquidity coming in here and the predominantly being on the bid, that looks like a spoof. If that looks like a spoof, what I'm thinking is that they're trying to get buyers in because they're expecting the adverse events to be on the sell side of this trade. And obviously from that point onwards, you can see that the selling does indeed come in. And that's what leads ultimately to these two adverse events here. It's the same thing. It's the same part of the process, but we can get in as early as possible by being vigilant to see this storyline happening here. This increase in liquidity means the market is rotating. And if there's too many bids, why is there too many bids? They're trying to spoof buyers in. Why are they spoofing buyers in? Because there are a lot of sellers in here. They're trying to get some of them to get taken off that number and see if they can fancy buying it. They didn't succeed on that occasion. They just pulled away the trade and all of a sudden the price was gone like an absolute train. So you can see these events taking place. Look at these two adverse selection sell events here. Another two adverse selection sell events, almost identical at price. Look, see they're almost identical price areas. Two adverse selection sell trades. Now obviously they're at the low price areas. So you're not going to sell that because they're already priced in. But what you're going to recognize is that somebody out of this area here was perhaps heavy selling this. And you can recognize that somebody there was heavy selling it. And if you like it as it develops, you might well then take a shot at some of these sellable opportunities from those events there just by recognizing those events. Gives you perhaps a series of sell trades up here. Certainly allows you to then look at your models to see why these adverse events were taking place and what you might be able to do about it. You can see there's an adverse event here, and you can recognize it's also a sell event. Well, again, you can see that this is very bearish, and it just keeps selling. It just keeps doing these trades over and over again, and you make a lot of money, sell side only, making $2,000 over the course of 40 or 50 minutes. So long as you're aware of these adverse events taking place in terms of liquidity being taken or delivered into the book. So these are different ways of seeing the market. You might not like any of them, you might not agree with any of them, but it leaves the question that I'm asking at the beginning of this classroom. If you don't know where fair value is, not historical fair value, but if you haven't got a current model about where the current fair value is and where it's moved from, how can you bid or offer for anything in the marketplace? Do you believe it's a good proposition to constantly bid above fair value and offer below fair value, real fair value? If that was the case, if the real value of a horse was 10 to 1 and the bookmaker was offering you 5 to 1, how many times is the horse going to win? Probably 1 in 10 races, right? But you're only getting 5 to 1 your money. So you're going to make a net loss of 5 points every 10 races, aren't you? You're going to make a net loss of 5 points every 10 races because you're constantly bidding at the wrong price against where fair value has been established by the bookmaker. If you're constantly trading below fair value as a buyer, you will not always win money, but you will make more money than lose. If you're always selling above fair value, you will make more money than you lose. It's as simple as that. It's not going to be on this trade or 2 or 3 trades later, perhaps. I mean, it's just probabilities. But if you constantly trade cheapness and richness to the marketplace, to fair value, you will come out in front. The challenge is finding it. The challenge is having a model or several models that provide you with that feedback information, not about historical, but about developing fair value. If your model at the moment doesn't do that for you, if your structure, if your market model that you're using just now, whatever it is, doesn't tell you where developing fair value is, then you really need to be thinking about this. If it does, good luck. I wish you all the best. I hope your model keeps developing because our models keep developing. They always change. We always change the models. We're always developing out new models and always looking at trying to stay in front of the market from a fundamentals, technicals, and an order flow point of view. Going to finish off with that and I'll hand you back to Kim. Hope there was something of interest in that. And if there was, then you know where we are. Please come and say hello and join us. And we will keep developing out these models through to Christmas. And we'll develop out a lot of these so that you can see how they play out, how you can take advantage of them, and in real time, see how they can actually become part of your trading arsenal going forward. Have a good one. I hope you've enjoyed it. If not, no luck. I'm not going to do it again. So I'll see you on the other side on Monday if you do. If you don't, as I said, good luck. Hopefully your trading is able to find a way of valuing the market in a way that perhaps we've described in some ways today. Have a good one. Ciao for now, guys.
Thank you so much, Ray. Excellent, excellent. Like I was saying, got to know where value is. We appreciate Ray join us, and I'm going to, as soon as he gets his stuff, he's finished off here, we will, there you go. I'm going to switch over and we'll talk about the upcoming, what Ray was saying we're going to be doing through the end of the year and into January, so that, traders that want to build a foundation, for those of you that have been in, it's a good time to come back, hit those back to basics. So give me just a second here, and I'm going to go ahead and switch this off and then give you guys the details on the boot camp.